Stocks are looking to build back after we saw a pullback in yesterday's trading. And your next guest says as global growth ramps up, there are still value sectors and companies presenting attractive opportunities, as well as individual growth stories that are worth owning at this stage. Gregory Branch is managing partner at Veritas Financial Group. Greg, it's great to have you on this morning. Let's talk about whether or not we are seeing certain parts of the market that are still buys, even though we're at record highs.
I think that's the case. Up until now, I was able to make the argument that we were seeing anemic multiples in some of these sectors. But the multiples have largely caught up over the last few months. Now my outlook is that the earnings are far too light in the back half of the year. The jobs number was a great indication of this, where it came in 50% higher than the consensus estimates. And so what I'm looking for is, particularly in those value and cyclical sectors, that the earnings revisions will keep coming in, and that we'll see significantly higher earnings for the back half of 2021 than we're seeing now, where we're at right now 60 to 70% of pre-pandemic levels in our estimates. So those will need to come up. We'll have some upside surprises on earnings. We'll have some upward revisions, and that will be the driver of performance.
All right, let's talk ideas, Greg. If that earnings catalyst is there, what stocks are going to be the most propelled by that kind of an earnings tailwind?
Right. So I think financials is still an opportune sector where we might see the net interest margin environment become much more accommodating, which lifts all boats. But I'd still focus in on those large diversified players that have shown profit drivers, that have shown revenue streams from other activities like capital markets, like trading, like IPOs, and with an accommodative Fed and with historic liquidity, those should continue to be sources of strength. I'd also look at some retail sectors. Obviously, spending will come back from the consumer, probably in a big way, but portions of our society have not participated in that historically high savings rate. And so I'm focusing in on the value shopping sector, and they're not all created equal. I'd really focus in on those that have taken the opportunity to invest in e-retailing. Remember, e-retailing has gained massive share over the last year, about a decade's worth of share in the last 12 months. And so the Walmarts and the Targets of the world will benefit both from the value shopping as well as from the e-retailing and separate themselves from the Targets and the Rosses of the world.
All right, and the reopening trade, we've talked about it a lot. It'll normalize at some point, but are there places in the market that are maybe outside traditional airlines and hotels that you are finding the most opportunity, the most runway for higher returns in the coming 6 to 12 months? Right.
And so the way I look at the reopening trade is I want to be in business models that are fairly predictable and then have some certainty. With airlines, with cruise lines, I don't really have that certainty, and quite frankly, neither do the CEOs, which is why we're lacking guidance. And so the first step I take is looking at the business models that I know, that I trust, and are predictable. And within that swath of sectors, I like casinos. You know, many of them lost money last year and will return to $3 plus a share in profits, as well as the same in dividend. And so you're going to see some pretty significant rebounds in some of those business models that are fairly predictable, that haven't been stigmatized, and then I think we'll have big years.
All right. Greg Branch with the Casino Call. Thank you very much for your thoughts. Have a good day, sir.
Thank you. Bye-bye.
All right.